We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. It is our belief, for the retail trader, the most successful trading strategy that exists in the marketplace is the analysis of a cause, its price and volume patterns, its relationship to support and resistance, and its ability to generate a tradable and extended effect is the only way to make money in the markets. Richard Wyckoff and also Richard Ney understood that demand and supply does work in the market, and that price and volume can expose the footprints of the very large players that allow the retail traders to piggyback on their actions. Now, it has been said that the stock market is random and it's too hard to trade, and you should just invest in indexes and what have you. Richard Wyckoff and Richard Ney debunked this. Sure, some markets are crazy and not well traded. That's because the composite man does not exist in that market. The composite man is the accumulation of individuals with big money who form an opinion in the market, who take the balance of what's going on in the market and they begin to show their footsteps through price and volume that the market is not random and it can be traded by the retail trader. All market players use these transaction types. Most markets allow shorting. For example, they buy stock or the commodity or what have you, and then they sell it, or they borrow on to short and they short cover. So these are the transaction types in the marketplace. Now, a merchandising operation held by the very large players builds up a portfolio of buys and shorting, and when they reduce their portfolio, they're either selling their buys or they're short covering their shorts. So a merchandising operation is the same as any retailer who buys umbrellas in the summer, knowing that in a few months' time that it's going to rain and there's going to be a demand for umbrellas, and they sell them at a higher price. Any retail operation is forecasting demand or forecasting what's going to be hot in 6 months, 12 months, 2 years. They buy the product now to sell at a markup or a margin in the future. That is the same logic that Richard Wyckoff and Richard Ney understand that the big boys do when they are accumulating and distributing stock, commodity and forex. Lucky for us, there's only two transactions type. They buy and they can short. So therefore, when the footprints of the market are price and volume. So we are looking for well-defined footprints that are left behind by these transactions in marketplaces that show a cause building up, demand coming in or supply coming in, demand overtaking supply, demand moving up markup through a price, the battle of supply through the markup. We're trying to see footprints that the big boys leave, the composite man, the informed of what's going on in the market, that allow us to piggyback on the staircase of those positions. Let's examine the merchandising operation in a little bit more detail. Here we have a perfect scenario of a stock. As we said before, the composite man will be buying umbrellas at a discount in summer, and they'll be selling them at a premium in the winter. In the winter they'll be buying summer hats at a discount, and they'll be selling them in the summer at a premium. This is the same operation that the composite man, the big boys, the informed, the smart money do when they buy stocks, commodity, forex, Bitcoin, whatever. Now what we have here, we're going to explain the change in stock levels of the transaction types. When we buy, the opposite is to sell. When we short, the opposite is to short cover. So the blue percentages resemble the stock build-up of buying transactions. You're adding stock float to your account. The red percentages shows the build up or the decrease of building up of short positions. So this is the performance of the informed, the smart money, the composite man. This is not the performance of the public or the uninformed or the dumb money. It is the complete opposite of these percentages. So as price comes down, the informed would be deciding to accumulate, and their percentages of ownership would build up along the accumulation. Alright? As volume changes hands, they're building up your accumulation. As price is marked up, they will be releasing stock float to the public, to the uninformed, or the late. And they would pretty much clear their account up here. The informed would be deciding to short up here, so they'll be building up their short position, and as the price is marked down, they're releasing the short position, which is the opposite of the accumulation. Now it's important to note through the markup process, they obviously realise that the late players are coming to the market and there'll be too much demand and it's going up too quickly. So they'll be releasing some of their stock float to slow the advance, to shake out people along the way, because they do not want to give easy wins to other people who've come late to the party after they've done all the work down below to accumulate. The news is used to manage their merchandising operation. You'll see your reactions will have news break and news come out and it have no reaction in price. News will come out and it will have reaction to price. The news is used and created, I must add, to allow these rather smart informed players to execute price action, or accumulate and distribute from the stock. It must be said the stock market has been purely designed to release funds from the public. So once you understand that and what you're up against, that is why we're after clear footprints of the merchandising operation, of the change in demand and supply. We want to see higher, if we're accumulating, we eventually want to see high volume up bars with low volume down bars. We want to see the unbalanced volume working with price. We want to see unbalanced volume showing it's a mirror of price. Now if we get a different pattern from unbalanced volume as to price, we want to know why. And the why is that large volume doing in that strange place? If we see volume in the funny little places where it shouldn't be, that suggests that the accumulation isn't done yet, or the distribution isn't done yet, or the markup may be breaking, or the markup isn't healthy. Volume in the wrong place gives an indication of things aren't all well with the composite man. So once again, the composite man is the most powerful thing in the market. They leave big footprints. And as a retail trader, our only chance to read the tape is understand Richard Ney and Richard Wyckoff logic. Now a lot of you may not have heard of Richard Ney, but Richard Ney wrote a book that goes into more detail explaining the merchandising operation and how these four transaction types, the buys, the sells, the shorts, and the short covering is used, and how to understand the inner workings of the he called the specialists. So within our RTT Plus service, we have a nice summary of how we refer to Richard Ney logic and how it works with Richard Wyckoff logic, and how to best utilize it, and how to best read price charts to show that the footprints are clear for the retail trader to start judging accumulation, distribution, markup and markdown. Thanks for watching.